2025 has been nothing but rowdy when it comes to the stock market, with trade wars, with things going on geopolitically. The stock market doesn't like uncertainty, and that's what 2025 has been. And the thing about stock market volatility is it's a normal thing. It doesn't mean that it's fun or it's easy to handle. So the thing I'm going to show you today is stock market crashes. They happen. Should you really be concerned or not? Let's dive in. Chris Heerlein here of REIT Financial, host of Retire Ready TV on KXAN, host of Wealth Radio for over a decade now on News Radio KLBJ. Tune in with me every week we're keeping you updated. We're keeping you informed with the latest and greatest. Also, I want you to click the subscribe button, hit the bell for notifications if you enjoy this channel. I drop new content all throughout the month. All right, so when it comes to stock market crashes, should you be concerned? Here in 2025, we've seen a lot of volatility. There's no doubt about it. And we're coming off of 2023, 2024, which were really great years in the market. Double digit, 16, 20% plus returns consecutively. That doesn't happen that often. The last time that happened was 1998 and 1999. Think about that. It's been a long while. And then what happened the next year? It was the dot-com bust. I don't think we're in a dot-com bust, but what I'm saying is that the market doesn't just go up indefinitely. And 2 consecutive market years, I see the investor trends with our very own clients, is that you forget that the market goes down faster than it typically goes up. And the investments that are steady and stable and sometimes boring, it's easy to get a little greedy and go, well, should we move out of that into something that could yield us more? And the thing about stock market crashes is that they're inevitable ever since the stock market was incepted. But when it comes to retirees, just like you, stock market crashes are more critical. Why? One, because you don't have the decades of time to save anymore like you once did if you're in your 60s and 70s, and you're drawing on your portfolio. So if you think back to your 20s, 30s, 40s, you weren't touching this money. In fact, you couldn't even touch this money without big taxes and penalties. The IRAs, the 401ks, you were just socking money away. And so when the market went down, every month, you were likely contributing and you were buying at cheaper and cheaper prices. And then what did it do? Came back and more. So when you're not drawing on your portfolio, market crashes, although not fun, create significant opportunity. Why? Volatility is key for Roth conversions and what's called dollar cost averaging. So many of you have heard for the years I've been on KLBJ, KXN, that Roth conversions are one of the most powerful ways to get control of your taxes, right? You want control, you want to keep your wealth, have it grow tax-free, that's all great. So if you've got an IRA or a 401k and the market drops 30%, just imagine your account goes down 30%. That's not fun. Hopefully you're not going to sell. Well, maybe it's time to convert. When you convert in your IRA or 401k, you're not selling at a market low. You're converting the same share of stock at a market low to a different tax designated account called a Roth. Now that money was converted at a 30% discount in this example. And when that market turns around, all that growth is tax-free forever. Second, when you're investing in the market, if the market drops 30% and you believe that the market will come back at some point, why would you not look to buy or at least continue to invest? We had, just this last month, a market that dropped thousands of points in 2 days. And guess what? Across this country, thousands of people likely sold. They didn't sell all, they may have sold some. And what happened the very next day? The market rebounded 2,000 points. It was one of the largest rebounds in history. This is all during the tariffs and trade war talk, right? Obviously, you cannot time when to buy. So obviously that dollar cost averaging through those years is a very powerful way to invest. Now, getting back to you retirees, why are market crashes so much more critical? Because you're not dollar costing in, you're dollar costing out. You're taking money every month out of your portfolio alongside your Social Security to maintain your standard of living, do what you've always dreamt of doing. So when the market's going up, in good market years, we'll see that every dollar you take is literally just the growth. In some cases, you may even have more money than you had at the start of the year because the market performed well. But when you're taking money out of the portfolio every month and the market's going down, that can be a death spiral. So what is your contingency? What is your plan? Is there another type of account that's not going down or maybe even going up that we could draw from instead? And you would be shocked at how important this tiny little strategy is and how much it can really prolong the longevity of your portfolio. I've shown examples over the years where it can extend your portfolio by literally over a decade just by implementing a contingency strategy. This could be as simple as having a bucket of cash, right? CD, money market, checking, savings, that instead of taking from the investments, we halt that and we go over here and we draw on this for a while until we start to see things turn around. That is a powerful strategy and one that can really help you mentally get around the emotional swings that come with a volatile stock market. All right, we're going to take a question from Matthew here. With my 401k, I'm just going to take out what I need each year to live, then put any unused into my money market, then it starts to earn interest again. Is there anything wrong with that? Just like Matthew did, I want to encourage you to leave your retirement questions in the comments below, and we'll get to those in future weeks. Matthew, it sounds to me like you're taking money out of the portfolio likely because you need it to live on, and two, you may be forced to be taking it through required minimum distributions. After 73, age 73, that's when the government says you got to take it out. You can't leave it in there. There would be really no reason you should be taking out more than you need every month out of the 401k to then put it in a money market, because every dollar that likely is taxed. So that's really a great point too, is you want to design your income to facilitate just what's needed every month. Do not pull out more than you need because it's going to be taxed. So getting back, yes, if you're forced to pull money out with the required minimum distribution, oftentimes retirees are using sometimes all of it for their retirement lifestyle. But if you're not using all of it, I want to be clear about something. You don't have to just put it in a money market. You can put it back into a brokerage account or an investment account that maybe could potentially do better than a money market over the years. In fact, I'm going to even take it a step further. You don't even have to sell the position. So if you have stocks over here, potentially that you want to hold on to, in some cases, you can just take what you need out of the 401k. Generally, it's out of an IRA. Take those positions and just put them into a brokerage account. So you don't even have to sell the investment to worry about cash going to a money market earning 3 or 4%. So there's a number of ways you can satisfy your required minimum distribution. And a lot of people think it's just got to go to cash. Another way is you can do what's called a qualified charitable distribution. So you can send a portion of whatever your required distribution is, Matthew. You can send a portion of that to a qualified charity or multiple charities, right? And that portion will not be taxable to you, but it still satisfies what the government is requiring for the year. So it's a very powerful strategy called a QCD. So again, we could probably talk about a couple different angles, but I want to encourage you, just like Matthew did, submit your questions in the comments section below. I'll get to those in future weeks. The last thing I want to cover today is when you think about these stock market crashes and should you be concerned, I want to encourage you to really look at what your money's doing, okay? So many of you, but in your retirement years, it's growth, it could be income, and importantly, preservation. So if your portfolio is whipsawing each day, the entire thing with the stock market, when I talk about your portfolio, I mean your entire wealth, right? All your money, all your investments, all your cash. That's not good. That's not good. So true diversification means you've got money that is steady and stable, very boring. And that's that account that I was talking about earlier that you can go to in the contingency. You want money that is generating income for you alongside your Social Security, and then you want money that is growing to at least, hopefully better, keep up with inflation. All right, click this next video to learn how to block out the noise.